President Trump just dropped a bombshell that's going to reshape your investment portfolio whether you're ready or not. Kevin Warsh, Trump's pick to replace Jerome Powell as Federal Reserve Chair in May, has a monetary policy philosophy that's radically different from anything we've seen in the past decade. And here's what almost nobody in the financial media is telling you. This isn't about interest rate tweaks or minor adjustments. This is about a complete philosophical reversal in how America's central bank operates. So what does this mean for your stocks, your Bitcoin, your gold and silver holdings? By the end of this video, you're going to understand Warsh's actual strategy, not the watered-down headlines. You'll know exactly why this could trigger more volatility than you've experienced in years, and why the long-term outcome might be more similar to what we have now than anyone expects. Let me walk you through the 3 critical pieces you absolutely need to understand. First, who exactly is Kevin Warsh, and why does his background during the 2008 financial crisis tell us everything about what's coming? Second, what is his monetary policy philosophy in plain English, and how does it compare to the Powell playbook we've lived under? And third, the investment implications. Which assets win, which assets suffer, and what timeline you should be thinking about as this transition unfolds. Let's start with the man himself, because Kevin Warsh is not some outsider who's going to walk into the Federal Reserve building for the first time. This is someone who served as a Fed governor from 2006 to 2011. Think about that timeline. He was inside the Federal Reserve during the worst financial crisis since the Great Depression. He wasn't watching from the sidelines. He was in the room helping design the emergency response. Bank rescues, liquidity programs, the early phases of quantitative easing. Warsh was there for all of it. Now, here's where it gets interesting. After he left the Fed in 2011, Warsh became one of the most vocal critics of the very policies he helped create. He looked at what the Federal Reserve had become, this constant money printing machine, and he said, this isn't what central banks are supposed to do. We've created a system where we're perpetually intervening, perpetually providing liquidity, perpetually preventing any kind of healthy correction or reset, and he's been arguing for a different path ever since. So what is that different path? This is where we need to cut through all the noise, because when you read the headlines, they'll tell you Warsh wants to cut rates and do quantitative tightening. Sure, those might be tactical tools, but that completely misses the strategic philosophy underneath. Let me explain the difference between what Powell does and what Warsh proposes, because it's night and day. Under Jerome Powell, the Federal Reserve's strategy is essentially preventive medicine. You see early signs of stress in the financial system, and you act immediately to prevent it from becoming a crisis. In December of last year, the Fed started purchasing $40 billion per month in Treasury bills. Why? Because the financial plumbing, the repo markets, the overnight lending facilities started showing signs of distress. Powell's philosophy is, don't wait for the emergency. Print money steadily, inject liquidity regularly, and you can avoid the crisis altogether. Now, there's a logic to this. If you can prevent a financial meltdown, prevent mass unemployment, prevent a deep recession, isn't that the responsible thing to do? The problem, and this is what Warsh has been hammering on for years, is that this approach has a cost, and that cost is persistent, elevated inflation. When you're constantly adding liquidity, constantly expanding the money supply, you never allow the system to actually clear out excesses. You never allow bad investments to fail. You never allow prices to reset. You just keep inflating the bubble, and the price of that is your currency loses purchasing power year after year after year. So here's Warsh's alternative, and I want you to really hear this because it sounds almost reckless at first. Warsh says, stop the constant money printing. Let the financial stress build. Let the market actually experience the crisis. And only then, only when there's a genuine emergency, a genuine panic, do you step in with overwhelming force. You flood the system with money, but you do it as a rescue operation, not as a routine maintenance operation. Now, why would anyone advocate for this? And here's where we can look at Warsh's own words from interviews he's given, where he lays this out explicitly. He says, central banks were created to respond to panics. That's the original purpose. When markets seize up, when there are no buyers and sellers can't find each other, when credit freezes, That's when the central bank shows up as the lender of last resort. You provide liquidity when no one else will. You backstop the banking system. You prevent total collapse. But the key word there is emergency. Warsh argues that by intervening constantly, the Fed has eliminated the discipline that markets need. Investors have come to expect that the Fed will always be there, will always provide a safety net, will always prevent losses. That creates what's known as moral hazard. It encourages excessive risk-taking because everyone knows the Fed put is there. Everyone knows that if things go bad, the central bank will rescue them. So Warsh's vision is to bring back what he calls the proper role of central banking. You're not the economy's permanent life support system. You're the emergency room. You're there for crises, not for routine checkups. And if that means allowing more volatility, allowing some companies to fail, allowing some corrections to happen naturally, so be it. That's how healthy markets are supposed to function. Now, I want to give you my analysis on this because I think there's something almost everyone is missing in this debate. Let me ask you a question. What's better, getting paid monthly or getting paid twice a month? Most people would immediately say twice a month, right? And the reason is obvious. If you're living paycheck to paycheck, that long stretch at the end of the month before your next paycheck arrives is stressful. You're scraping together money, you're stressed about bills, you're counting days. Getting paid bi-weekly smooths that out. You never have to wait as long. But here's the thing. At the end of the month, you've been paid the same total amount either way. The only difference is the timing and the distribution of stress. And I would argue that's exactly what we're looking at with Powell versus Warsh. Both approaches end up printing money. Both approaches end up expanding the money supply. Both approaches lead to inflation and dollar devaluation over the long term. The only difference is the timing and the distribution of the pain. Powell gives you steady, predictable interventions. It's like getting paid bi-weekly. You know what's coming, you can plan around it, there's less acute stress, but you're also getting constant low-grade inflation, constant loss of purchasing power, constant erosion of your savings. Warsh gives you lumpy, crisis-driven interventions. It's like getting paid monthly, but worse, because you don't even know when the paycheck is coming. You have to wait for the crisis, and then boom, massive intervention. That means more volatility, more uncertainty, more acute stress during the crisis periods. But at the end of the day, when you zoom out and look at the total amount of money printed, look at the total inflation over a 5-year or 10-year period, it's probably going to be similar. So what Warsh is really proposing isn't a solution to inflation. He's not offering a path back to sound money or to a strong dollar or to ending devaluation. He's offering a different distribution schedule for the same underlying problem. And I think that's the part the financial media isn't explaining clearly enough. They're presenting this as if Warsh represents some kind of hard money revolution, some return to fiscal discipline. But when you actually listen to what he's saying, he supported the 2008 bailouts. He supported doubling the Fed's balance sheet in a single quarter. He just wants to reserve that kind of action for emergencies instead of making it routine. Now, does that mean nothing changes? Absolutely not. Because even though the long-term destination might be similar, the journey is going to feel very different. And for investors, the journey matters just as much as the destination. So let's talk about what this means for your portfolio, because this is where theory meets reality. In the short term, and I'm talking about the first 6 to 12 months after Warsh takes over in May, I expect significantly higher volatility across all asset classes. And there are 3 reasons for this. Number 1, policy uncertainty. Markets are going to be trying to figure out exactly how serious Warsh is, how quickly he'll implement changes, whether Trump will pressure him to maintain liquidity for political reasons. That uncertainty alone creates volatility. Number 2, mixed signals. Warsh has talked about cutting interest rates, but also doing quantitative tightening, letting the balance sheet run off. Those are contradictory signals in some ways. Lower rates should boost asset prices, but reduced liquidity should suppress them. Markets hate mixed signals. They want clear direction. And number 3, the Fed put gets called into question. For the past 15 years, investors have operated under the assumption that if markets fall too much, the Fed will step in. That's been true under Bernanke, under Yellen, under Powell. But Warsh is explicitly saying he wants to let crises happen before rescuing. That means the Fed put might be at a much lower strike price than investors are used to. Maybe the Fed doesn't step in at a 10% correction anymore. Maybe they wait for 20% or 30%. Nobody knows. And that uncertainty is going to make investors more nervous, more trigger happy, more prone to selling on bad news. So short term, buckle up. Volatility is coming, but what about the medium term? Let's say 12 to 24 months into a Warsh chairmanship. Here's where I think we see a real rotation in what works and what doesn't. If Warsh actually follows through on reducing routine liquidity injections, that means less money sloshing around the system looking for a home. And when there's less liquidity, investors become more discriminating. They can't just buy everything and assume the rising tide lifts all boats. What does that mean practically? It means a rotation out of speculative, growth-oriented, unprofitable companies and into value-oriented, cash flow positive, fundamentally sound businesses. During periods of easy money, you can get away with investing in companies that lose money every quarter, but promise future growth. The Tesla model, the Uber model, the entire venture capital ecosystem model. You're not investing based on current profits. You're investing based on future potential funded by continuous capital raises. But when liquidity tightens, that model breaks down. Investors want to see profits now. They want to see cash flow now. They want assets that can survive without needing constant refinancing. So I would expect large-cap value stocks, dividend payers, boring profitable businesses to outperform. And I would expect speculative growth stocks, especially unprofitable ones, to struggle. Now let's talk about Bitcoin and cryptocurrency specifically, because this is where Warsh's policy could have the most dramatic impact. Bitcoin, whether people want to admit it or not, trades like a leveraged technology stock. When liquidity is abundant, when interest rates are low, when investors are feeling risk on, Bitcoin soars. We saw this in 2020 and 2021 when the Fed was printing trillions. Bitcoin went from under 10,000 to nearly 70,000. But when liquidity tightens, when the Fed starts raising rates and doing quantitative tightening, Bitcoin gets crushed. We saw this in 2022. Warsh's philosophy of withholding liquidity, except during crises, is terrible for Bitcoin. Because Bitcoin doesn't generate cash flow, doesn't pay dividends, doesn't have earnings. Its value is entirely based on future adoption expectations and liquidity conditions. In a low liquidity environment, Bitcoin becomes a luxury asset that investors sell to raise cash for safer opportunities. Now, I'm not saying Bitcoin goes to zero or that it's uninvestable. Long-term believers in Bitcoin as digital gold or as a hedge against fiat devaluation can make a case regardless of Fed policy. But if you're asking me whether a Warsh-led Fed is good or bad for Bitcoin in the medium term, it's unequivocally bad. I would go so far as to say Warsh could be the worst Fed chair for Bitcoin we've ever had. Because even when other chairs were raising rates, they were still providing some liquidity, still backstopping markets in small ways. Warsh is proposing to remove even that. What about gold and silver? Here's where it gets more nuanced. In the short to medium term, precious metals could struggle for the same reason Bitcoin struggles. Reduced liquidity means less speculative capital flowing into non-yielding assets. If investors are worried about a crisis, and Warsh isn't preventing it, they might prefer holding cash or short-term treasuries over gold. But here's the long-term case for precious metals that I think still holds under Warsh. Everything we've talked about. Warsh's willingness to do massive money printing during crises, the continuation of inflation over time, the ongoing devaluation of the dollar, the geopolitical trend toward de-dollarization. None of that changes. Warsh isn't proposing to end the money printing. He's proposing to make it crisis-driven instead of routine. But the total amount of printing over a 10-year period could end up being the same or even higher if we have multiple crises that each require overwhelming responses. So if you're a long-term precious metals investor, someone who's holding gold and silver as insurance against currency debasement and loss of confidence in fiat money, Warsh doesn't change your thesis. In fact, you could argue he makes it stronger because the volatility and crisis-driven approach could accelerate the loss of confidence in central bank competence. People might start asking, why are we trusting institutions that intentionally allow crises to happen just so they can heroically rescue us? That's not confidence-inspiring. Now, I need to address the elephant in the room because there's a real possibility that everything I've just described doesn't happen. And that possibility is this: talk is cheap. What Warsh says he's going to do and what he actually does once he's in the chair could be completely different. We've seen this movie before. Central bankers talk tough about tightening, about discipline, about letting markets function, and then the market drops 10% or 15%, and suddenly they're back to printing money and cutting rates. Why would that happen with Warsh? Well, think about the political context. Trump nominated him. Trump cares deeply about stock market performance. Trump views the stock market as a report card on his presidency. Do you really think Trump is going to sit by quietly while Warsh implements a policy that causes the S&P to drop 20 or 30%? Do you think Trump won't be on the phone, on Twitter, publicly pressuring Warsh to cut rates and provide liquidity? There's also the midterm election factor. The midterms are in 2026. That's the same year Warsh takes over. Do you think Trump and the Republican Party want to go into midterms during a market crisis that they allowed to happen? The political pressure to keep markets elevated, to keep the economy humming, to keep voters happy is enormous. So here's the scenario I actually think is most likely, and I'm giving you my honest opinion here. Warsh takes over in May. He talks about discipline and tightening and letting markets function. Maybe he makes some token moves in that direction. But then the first real sign of trouble appears. Maybe it's a regional bank failure. Maybe it's a spike in corporate defaults. Maybe it's a sudden drop in the stock market. And Warsh blinks. He steps in with liquidity just like Powell would have. He cuts rates, he buys assets, he provides support. And at that point, the market realizes that nothing has actually changed. The Warsh Fed is just the Powell Fed with different rhetoric. And we're right back to the same playbook we've been living under for 15 years. Constant intervention, constant money printing, constant inflation, constant dollar devaluation. Is that cynical? Maybe. But it's also realistic based on the track record of central banks and political pressure. The path of least resistance is always to print money and kick the can down the road. And until I see actual evidence that Warsh is willing to endure serious political and market pain to stick to his principles, I'm going to assume he'll follow that path of least resistance just like everyone else. So where does that leave us as investors? How do you actually position yourself given all this uncertainty? Let me give you my framework, because I think there's a smart way to approach this without having to make a binary bet on whether Warsh is for real or not. Number one, prepare for volatility. Regardless of whether Warsh implements his philosophy or caves to political pressure, the transition period is going to be rocky. We're going to have conflicting signals, policy uncertainty, market mood swings. That means you want to have some dry powder, some cash on the sidelines, so you can buy assets when they get unfairly beaten down. It also means you might want to reduce leverage, reduce exposure to the most speculative parts of your portfolio, at least temporarily. Number two, diversify across the scenario outcomes. If Warsh is serious and actually restricts liquidity, you want value stocks and cash flow positive businesses. If Warsh talks tough but then prints money anyway, you want hard assets like gold and silver and Bitcoin. The smart move is to own both. Don't go all in on one scenario. Spread your bets. Number three, focus on the long-term trend that doesn't change regardless of who's Fed chair. And that trend is the devaluation of fiat currency, the loss of confidence in central banking, the shift toward hard assets and decentralized alternatives. Whether it happens steadily under Powell or lumpily under Warsh, it's happening. So make sure some portion of your portfolio is positioned for that reality. And number four, stay flexible. Don't fall in love with a narrative. Don't get so committed to the idea that Warsh is going to revolutionize the Fed that you ignore evidence to the contrary. And don't get so cynical that you assume nothing ever changes. Watch what actually happens, not just what people say. Watch the data. Watch the Fed's balance sheet. Watch what happens when the first crisis hits, and adjust your positioning accordingly. Because here's the truth, nobody knows exactly how this is going to play out. Not me, not the analysts on Wall Street, not the financial media, probably not even Warsh himself. We're in a period of transition, and transitions are inherently uncertain. But uncertainty doesn't mean you're powerless. It means you need to be thoughtful, diversified, and adaptable. Let me bring this all together because we've covered a lot of ground, and I want to make sure the key points are crystal clear. Kevin Warsh is not an outsider. He's a Federal Reserve insider who was there during the 2008 crisis and supported massive intervention at that time. He's not against money printing, he's against routine money printing. He wants to reserve the money printing for emergencies and do it with overwhelming force when the time comes. This is different from Powell's approach of steady, preventive liquidity injections, but it's not necessarily better for your long-term purchasing power, because both approaches lead to money supply expansion and inflation over time. The difference is the distribution, smooth and predictable versus lumpy and crisis-driven. For investors, this means more volatility in the short term as markets adjust to policy uncertainty. It potentially means a rotation from speculative growth to value and cash flow in the medium term if liquidity actually tightens. And it almost certainly means that Bitcoin and crypto will struggle in a reduced liquidity environment, while precious metals maintain their long-term appeal as insurance against currency debasement. But there's a real possibility that Warsh ends up printing money just like Powell once political and market pressure builds. And if that happens, we're right back to the same inflationary trajectory we've been on, just with more volatility along the way. So the action steps are clear. Prepare for increased volatility. Diversify across scenario outcomes, maintain exposure to hard assets as long-term insurance, and stay flexible because this situation is going to evolve in real time, and you need to be able to adapt. The most important thing you can do right now is stay informed, think critically, and don't just accept the mainstream narrative at face value. Whether it's Warsh or Powell or whoever comes after, the underlying dynamics of our monetary system, the incentives, the political pressures, the mathematical constraints, those don't change just because we swap out one person for another. If you found this analysis valuable, if it gave you a framework for thinking about the Warsh nomination that you didn't have before, I'd appreciate it if you'd subscribe to the channel and share this video with anyone else who's trying to navigate these uncertain times. And drop a comment below. I want to know what you think. Do you believe Warsh will actually follow through on his philosophy, or do you think he'll cave to political pressure? What are you doing with your portfolio in response to this news? Thanks for watching, and I'll see you in the next one.